Hello everyone, today I'm going to discuss on whether to buy the split for Google and buy the dip for Facebook aka Meta platforms. For those who are not aware, Google recently announced a solid Q4 earnings and stock split, which sent the stock price soaring during after-market trading, while on the other hand, and on another day, Facebook announced a not so good earnings and future growth, which caused the stock to plummet more than 20%. But before I dive into the details, as usual, hope you can help with the YouTube algorithm by liking this video. Your little support means a lot to me. First up, Google. They reported an outstanding Q4 earnings which outperformed the market expectations. And what excited the investors even more was the announcement of a stock split of 20-for-1. Meaning to say, if you are holding one share of Google share now or by 1st July, it will magically poof into 20 shares on 15 July. These announcements caused the stock price to jump by about 9% during after-market trading, from about $2,500 to around $3,000. So here's my take. It clearly shows that many investors are very reactive and FOMO. Maybe they love the stock 3,000, but sorry, I don't love it at 3,000. One day after the earnings call, I posted on Momo that investors should be wary of a potential pullback when the stock price goes up too quickly. Never ever chase a raging bull. True enough, it went down to about $2,800+ in the next 2 days. It was evident that many investors bought the stock based on euphoria and excitement, as they forgot about the basic principle of the faster the stock goes up, the higher chance it will fall. Steady rise is always better. So at this point, I don't love Google at $3,000 yet, but I love it at $2,700 to $2,800 range, and that will save me a few $100. Another thing that I would like to share is that one should not buy stock because of news like stock splits. You should buy it only if you have high conviction and trust in the company, and you are very much aware of its fundamentals. The truth is, stock split doesn't change the amount of money you invested in. For example, you put in $3,000 today to buy one Google stock. Come July, the one share that you have will be split into 20 shares of $150. That's all. The $3,000 that you invested in remains the same. We call this LPPL in Singapore. Anyway, the example was on the assumption that the price didn't go up or down for illustration purpose only. Though some may argue that when the stock price becomes more affordable after the split, more retail investors can purchase Google's shares, and thus driving the price up. That's true to some extent, but hey, stock split is in July, which is like 5 months away from now. You mean those retail investors who have little or no purchasing power will start printing money and pumping in 10 to 20,000s to the shares now? Furthermore, so many things can happen in the next 5 months. For example, the most certain thing that will happen is the interest rate hike by the Federal Reserve, and this is just one certainty among many other uncertainties. Therefore, the point here is don't FOMO when it's soaring up like a beast. Let the stock price settle a little, and buy into it periodically. And it is important that you buy the stock because of its fundamentals. For example, you have done your research and is convinced that they will beat expectations again in the next quarter, or you are confident that their market share will not be threatened by its competitors, which happened to Facebook. So this brings me to the next stock, Facebook aka Meta platforms. During the recent earnings call by Facebook, they reported an underwhelming Q4 results. In essence, their daily active users dropped for the first time in history, and hence their stock also created history by crashing more than 25%, setting a record for the largest one-day value drop in stock market history. The crash wiped out more than $250 billion in their market cap, and to put things in perspective, Disney's market cap is about $258 billion, so that's like almost erasing an entire Disney off the book. But of course, the drop isn't just caused by the decline in their DAUs. There are other factors such as increased competition from TikTok, higher operating costs for the Metaverse and Reality Lab, pessimistic forecast for the next quarter, revenue impacted by Apple's user privacy updates, etc. So a combination of all this caused the stock to fall from heaven to earth. And I'm sure more of such news in the next quarters will send it beyond earth to hell. Anyway, with this crash, some investors are saying that Facebook stock is dirt cheap now and we should buy the dip. Again, these are people trading and investing based on emotions. They feel that the stock will go up eventually cause Facebook is too big to fail. To be honest, no company is too big to fail. Look at eBay and IBM or Intel. These are all big names, but look at where they are now and how much market shares have they lost over the years. When it comes to investing, we always talk about the company's fundamentals. For this case, I must say the fundamentals have changed to some extent. Their market share is threatened by TikTok and other players like Snapchat, Pinterest, etc. And to make things worse, the Facebook platform is hitting a plateau and its DAUs are likely to decline further. Admit it, those who are using Facebook are 30s and above. It's hard for them to attract younger crowd. In addition, the company is pivoting to a new and unknown concept, Metaverse. So all these have shown that their fundamentals have shifted. Therefore, as an investor, you will need to know these underlying red flags before rushing and chiong to buy the dip. Not every dip is nice, by the way. So don't blindly buy and hope that the stock price will go up. As I have mentioned before, hope is not an investment strategy. Anyway, here are my views on Facebook, but please note that they are not financial advisors. To be transparent, I am a Facebook stockholder and my price is at $300 ish, so I am looking to average down to 200 plus cautiously. Okay, so despite the red flags, I still see reasons to believe in the company. First and foremost, the CEO is very much aware of the fierce competition faced by the company, and he probably knew that Q4 results may not be that great, and that could be the reason why he decided to change the company name and pivot to Metaverse early. To be honest, I will be more worried if they are not doing anything to innovate, pivot or attempt to revive the company's growth. I can see that they are trying to create a new S-curve for Metaverse. Though this move will eat into their operating expenses, and there are uncertainties, I believe their safety net is their family of apps and their ad spaces. The company is still a giant in the online ad segment and is still making money. Yes, their DAUs for Facebook has declined, but one cannot deny that Facebook together with Instagram still have its value proposition for advertisers. And advertisers will not pull out their money overnight just like the stock market. And of course, other factors such as market is overreacting, their solid management team, forward PE ratio, potentially solving or navigating through the iOS issue like how Snapchat did, the company is a cash cow, shares buyback program, etc. also play a part in my conviction. I still believe there are some upsides if your time horizon is 5 years or more. Who knows, the current event and sell-off could be just a blip in 5 years' time. Similar to how Apple shares experienced massive drop on a few occasions over the years. And Microsoft stock was stagnant during the early 2000s. Personally, I believe the price will still go up from here after the dust has settled, but it will not give you monster gain like other growth stocks. To sum it up, the company is going through metamorphosis as it intentionally moved beyond being a social media company. They are selling the Metaverse story, and I am buying this story. Well, I could be wrong. If there is only one reason to draw from Facebook's crash, that is, things can change along the way, and it is therefore important to stay nimble. Anyway, if you wish to consider other stocks to invest in, you can check out my other video on safe stocks to invest. Okay, that's all for this video. Are you invested in Google and Facebook? What are your thoughts? Let me know in the comments section below. Lastly, thanks for watching my video. Hope you can like, share and subscribe to my channel to show a little support. Thank you.